If I offered you $1 today and promised to double it every day for a month, would you take it? It doesn't sound like much, right? A dollar? But what if I told you that by day 20, that single dollar would have turned into over $500,000, and by day 30, it would be over 500 million? Most people would pass on the initial offer, not realizing they're turning down a fortune. That incredible, mind-bending growth is the power of compounding. Today on Financial Essentials, we read pulling back the curtain on what Einstein supposedly called the eighth wonder of the world, compound interest. It can feel like financial magic, but it's a real tool you can use to grow your money often while you sleep. We're going to break down exactly what it is, how it works, and most importantly, how you can make it work for you. Let's dive in. So, what exactly is this mysterious force called compound interest? It's actually surprisingly simple. It just means you earn returns not only on your original money, the principal, but also on the returns that already earned. That's the entire definition. You're earning interest on your interest. Let's contrast that with its less powerful cousin, simple interest. With simple interest, you only ever earn returns on your starting amount. If you invest $1,000 at 5% simple interest, you earn $50 this year, $50 next year, and $50 10 years from now. It's predictable, but it's flat. It never grows on its own. Compounding, on the other hand, creates a snowball effect. Your investment grows, and then the next round of interest is calculated on that new, larger amount. So the growth gets bigger and bigger over time. This is why time is the most crucial ingredient in the entire recipe. The longer your money stays invested and continues to compound, the faster and more dramatically it accelerates. It's not about being a genius investor. It's about letting a simple mathematical principle do the heavy lifting for you year after year. Let's walk through a clear example to see this in action. Imagine you invest $1,000 into an account that earns an average of 8% per year. In year 1, you earn $80 in interest. Simple enough. Your total is now $1,080. But here's where the magic starts. In year 2, you're not earning 8% on your original $1,000. You're earning 8% on $1,080. So your interest for year 2 is $86.40. Not a huge jump, but your money is now $1,166.40. You earned an extra $6.40 just because your previous earnings started working for you. Now let's fast forward. If you let that $1,000 sit there for 30 years without adding another penny, that initial investment would grow to over $10,000. The growth in the final years would be massive compared to the early years. In the 29th year, you'd earn over $700 in interest alone, almost as much as your entire initial investment. That's the exponential power of compounding. It starts slow, almost invisibly, but over decades, it builds a financial force that can change your life. To truly understand why compounding is so powerful, let's look at the most important factor, starting early. Time is your greatest ally. Let's imagine two people, Alex and Jordan. Alex starts investing at age 20. She diligently puts $200 a month into an investment account. She does this for 10 years until she turns 30. In total, she has invested $24,000. Then she stops contributing completely and just lets the money grow. Now let's look at Jordan. Jordan waits until he's 30 to start investing, the same age Alex stopped. He also invests $200 a month, but he does it for 30 straight years, all the way until he's 60. His total investment is $72,000, 3 times what Alex put in. Who do you think has more money at age 60? In many scenarios, assuming a standard market return, Alex, the one who started early and invested less, ends up with more money. Why? Because her money had an extra 10 years to compound. Those first 10 years are the most powerful because they have the longest time to grow. The lesson here is crystal clear. The best time to start investing was yesterday. The second best time is right now. Time in the market almost always beats trying to time the market. So you're convinced. You want to harness this power for yourself. How do you maximize compounding and really get that snowball rolling downhill? Here are the key strategies to supercharge your growth. First, invest regularly. Make it automatic. Whether it's $50 or $500 a month, consistency is what builds the foundation. Second, reinvest your dividends. Many stocks and funds pay out dividends. Instead of taking that cash, automatically reinvest it to buy more shares, which then earn their own returns. You're compounding your compounding. Third, and this is a big one, avoid pulling your money out. Every time you withdraw from your investments, you're not just taking out that money. You're stealing decades of future growth from yourself. Fourth, keep your fees low. High fees on investment funds act like a constant drag on your returns, slowly eating away at your compounding potential over time. And finally, stay invested, even when the market drops. It's tempting to sell when things look scary, but market downturns are often the best times to be investing. You're buying shares at a discount. The single biggest enemy of compounding is interrupting the process. Let it work. Now, you might be thinking, what about my savings account? Does it compound too? The answer is yes, but there's a crucial difference between saving and investing. A high-yield savings account is a fantastic tool. Your money is safe, and it does earn interest that compounds, usually daily or monthly. This makes it the perfect place for your emergency fund money you need to access quickly and can't afford to risk. However, the interest rates on even the best savings accounts are typically much lower than the long-term average returns of the stock market. For long-term goals like retirement, investing is where compounding really shines. When you invest in things like broad market index funds or your 401k, when you invest in things like brand K, you're taking on more risk, but you're also positioning yourself for much higher potential returns over many years. This higher rate of return is the fuel for explosive compounding. So it's not about savings versus investing. It's about using the right tool for the right job. Savings for short-term safety, investing for long-term growth. Even with the best intentions, it's easy to make mistakes that sabotage your compounding journey. Let's cover the most common ones so you can avoid them. The biggest mistake, as we've seen, is simply waiting too long to start. Every year you delay is a year of compounding growth you can never get back. Another common pitfall is trying to be a day trader. Constantly buying and selling, trying to time the market's peaks and valleys is extremely difficult and often leads to lower returns than just buying and holding. It also racks up fees and taxes, which further erode your gains. Similarly, panic selling during a market crash is a classic mistake. You lock in your losses and miss the eventual recovery. Choosing investments with high fees is another silent killer of returns. A 1 or 2% annual fee might not sound like much, but over 30 or 40 years, it can consume a massive chunk of your final portfolio. And finally, cashing out retirement accounts when you change jobs is a huge error. You'll get hit with taxes and penalties, and you completely reset your compounding clock. The real secret to successful long-term investing isn't being a genius, it's being consistent. Boring wins. So what does this all mean in practical terms? Let's imagine you start with nothing and just invest $100 a month. That's about $3 a day. If you do that consistently for 40 years and earn a historical market average of around 8%, how much do you think you'd have? That small, consistent habit could grow to over $340,000. What if you could manage $300 a month? By the end of those 40 years, you'd be looking at over $1 million. This isn't because you started out rich or got some secret stock tip. It's because you were consistent and you were patient. You let the simple, unstoppable math of compound interest do the work for you over a long period of time. That is the true, accessible power available to everyone. In the end, compound interest isn't really magic, it's just math. It's a predictable, reliable formula based on time and consistency. But when you truly commit to the process, when you respect the power of time and you let your money work for you day after day, year after year, it sure can feel like magic. It's the closest thing we have to an automatic wealth-building machine. Thanks for joining us on Financial Essentials. If you want to keep learning more money fundamentals to build a better financial future, be sure to subscribe. We'll see you next time.